Tom, I just want to ask you about this. In speaking with various sponsors, what were some of the most important customizations that they were looking for in a direct indexing provider? And what were some of the more surprising needs that came across?
Yeah, so this is a survey we did of about 30 wealth management firms, wirehouses, independent broker-dealer firms, large RIA firms, and these would be the executives at those firms responsible for creating their programs. And you know, obviously taxes is the number one thing you hear time and time again. But as I mentioned, you know, what I wasn't aware of is this whole tax transition issue, which is really a huge issue for advisors out there. And you start to hear things like factor investing, thematic portfolios, excluding industry sectors, things like that. They tend to be lower ranked. Another one that we've heard of, which we've heard from advisors about, is downside protection. It was kind of amazing to me, a survey we did about how much those who invested in indices were interested in it. But the more you think about it, we've had this bull market run. There might be some advisors that are really still interested in index investing, but protecting their clients should we have a market correction. So I think there's a lot of things that are out there. Taxes are real obvious, ESG is emerging, but there's probably a lot of different ways of customizing these portfolios that we hadn't even thought of.
Interesting. Well, yeah, not surprisingly, whether it's loss harvesting or the tax efficient transitions that you mentioned, tax management is one of the most appealing customization capabilities of the solution for taxable clients. Brian, how does Parametric approach tax management for our clients? And what kind of value add can one come to expect from that sort of active and systematic tax management?
Yeah, so the opportunities to customize a portfolio for an individual investor's tax situation are broad, and they're valuable and they're powerful. And I think probably one of the best trade-offs in money management. The first, I think, the one that comes across for most is the ability, and Tom mentioned this, to harvest losses, to screen the portfolio constantly every day throughout the course of a year, and wait for opportunities where individual securities fall significantly below their cost basis, their purchase price, sell that, crystallize that loss, and then reinvest the proceeds in other securities across the portfolio, and do that opportunistically, do that consistently across the entire year, not just at the end of the year. And that's kind of that's table stakes, I think, within direct indexing SMAs, to do that loss harvesting and to do it well, and to manage that trade-off between tracking or providing that broad market exposure and tax benefit. Right up front, we talk about tax transitions, how to build a portfolio that takes into account pre-existing holdings, their unrealized gains and losses, their holding periods. About half of the portfolios we create come with pre-existing securities, so certainly. But once an advisor and a client understands those two kind of basic building blocks, ongoing systematic loss harvesting, working around transitions, there are other things that become a real powerful component of the conversation. We love to talk about charitable gifting and the philanthropic side. Clients in this space who do systematic or regular gifts to charity can use a direct indexing portfolio to have a dual benefit of funding that charitable wish, but also do it in a way that is done with the highest unrealized gain tax lots within the portfolio. So they get the deduction, but they also extinguish the capital gain because the charity gets the unrealized gain and sells that security. We get involved in estate planning. We get involved in regular examples where a portfolio gets created in different trusts. It's all centered, as Tom mentioned, around this dual objective: capture the broad market return, be consistent in that, but use the customization to create value. And it's kind of opening up many opportunities. Ultimately, though, and I think that's the bottom line of what you're asking about, Megan, is we see clients after-tax performance exceed that of a benchmark by 100 to 150 basis points a year for long periods of time. So the ultimate value will depend on the client's circumstances, what they do, what the market environment is. But over nearly 30 years of running these portfolios across lots of different tax regimes and tax circumstances, we've seen an average of 100 to 150 basis points per annum for as many as 10, 15 years. So a very significant opportunity. I think that is motivating the industry to take a look at it.
Yeah, and I imagine that comes through the systematic loss harvesting that happens unprompted, right, throughout the year. I know personally, we're in December already, and I have some cap gains in my portfolio, and now I'm kind of scrambling to find losses to help offset them before year end. And I think a lot of us investors and advisors alike think to loss harvest at year end. And a strategy like this seemingly takes that onus off the plate of the advisor and client and identifies those opportunities whenever the volatility pops. You quantified what we term as tax alpha, or the value of loss harvesting, to be about 150 basis points over prolonged periods of time. Over time, does it become impossible to continue to loss harvest accounts? Is there just a point where you can't loss harvest anymore?
Well, you're absolutely right. And that's, to us, I think, the ultimate good outcome of a portfolio like this, in that the portfolio tracks along with the market. It provides that overall beta exposure, that equity risk premium in the equity case, which is so important to the client's asset allocation, plays that role. As we harvest losses and the cost basis of the portfolio continues to get pushed down, eventually the portfolio finds itself in what we call lockup, when there are very few, if any, of the tax lots or positions in the portfolio which are close to the cost basis equals market value, and it's all unrealized gains. And then our job turns to being able to manage that portfolio to continue to reflect the market with the least amount of capital gain realization. Some people view that as a criticism of direct indexing and loss harvesting, that eventually the loss harvesting opportunity runs out. But I view that as a wonderful outcome. Here you are, you participated in the market for long periods of time, you've captured the pre-tax total return, but you've also had an enormous tax benefit, and you still have a broadly diversified portfolio which you can maintain. And that can be used for gifting, it can go through the estate process, it can. So ultimately, yes, if markets work and they trend up, and yes, if we are aggressively harvesting losses per our mandate, we will end up with a portfolio that doesn't have any more losses to harvest.
Just pivoting a little bit, we've already touched upon this. Responsible investing, I think it is an industry-wide trend that has actually found quite a nice home in direct indexing. Brian, what kinds of responsible investing offerings does Parametric have, and how have we partnered with advisors to help create really personalized, values-based portfolios for clients?
Yeah, as was mentioned earlier, individual clients and the advisors who serve them come to the table in this ESG space with very idiosyncratic, unique ideas about how they want to tilt portfolios, what matters to them. And it is difficult at times to find a commingled vehicle or a portfolio manager who reflects their values, your values, in a way that's comfortable, in a way that really scratches that itch or meets that need. So there are cases, and we love to do this, where we will work with an advisor or a client to create a set of screens off of a screen menu, or in some cases a bespoke screen. A great example at Parametric, one that is probably more dramatic than most, is we worked with a client who had a passion about combating human trafficking globally, and not finding a screen or a set of data that adequately reflected that. We worked with that client and a set of research providers and data providers to create a human trafficking screen that started with her portfolio and now has been made available to all our clients. And I think we have 700 plus clients and over $3.5–4 billion in assets which utilize the human trafficking screen. Now that's on one end of the spectrum. And there's a whole spectrum of opportunities for advisors and clients to do things, whether they're doing something like screening out tobacco and alcohol, or reflecting their own religious screen lists that come from their religious organization, or fossil-free portfolios and climate change portfolios, diversity portfolios are all very, very topical. But this is an area where customization does meet direct indexing's opportunity and capability in a great way because of the unique. Everybody has a unique tax circumstance. Everybody has a unique holding period, cost basis set of circumstances. And most people have unique ideas around how to express ESG in their portfolio. And we love to give people that control.
Yeah, and I'd add people and institutions, foundations alike. I think, we work with many non-taxable investors that obviously don't need to employ the tax management techniques, but they're looking for that customized, responsible investing portfolio that will suit their needs that they just can't get with the off-the-shelf strategies. When we talk about direct indexing, we're often speaking to equity indexing with tax management and with customization, just as we've been doing for the past 20 minutes. Are there applications in the fixed income space?
There really are. You have to shift your mindset just a bit, because as Tom mentioned when he opened the conversation today, the majority of what people think about when they think about direct indexing, they think about following a broad-based equity market portfolio. But there are fixed income market portfolios or fixed income indexes, and we do create custom core, that's our brand name, direct indexing portfolios in the fixed income space. We also, and even more popular and more commonly, will create a rules-based fixed income portfolio that is called the laddered portfolio, which ladders across the maturity spectrum, both corporate and municipal fixed income securities, to create a systematic rules-based portfolio, and then rebalances automatically as the short paper becomes redeemed. And these portfolios as well can be and are customized to state-specific needs, to tax. They can be tax managed, tax loss harvested. We have an ESG capability. So we have a significant business that we feel is an analogy to direct indexing on the equity side, where we create and manage fixed income separate accounts, either index targeting or laddered portfolios, and bring customization to bear in many of the same ways as equity. And I think that is essentially that same dual advice: capture the market, however it's defined, capture the segment, however it's defined, and then bring customization to bear to add value.